Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today, Mena, I'd like to talk about some common accounting errors. Now, it might sound like a really boring podcast. Hopefully it's not. Hopefully we can make it, well, I was going to say exciting. I won't overpromise, but useful is probably the best way to describe it. I mean, really, your accountant occupies a pretty significant role if you're running a business. You know, they're sort of your CFO, if you like, particularly if you don't have a business large enough to employ one directly. And so you're putting a lot of faith in they know what they're doing, that they're doing it appropriately, that whatever they're doing today or last year, isn't going to create problems or issues down the track. But the problem is you're not an accountant yourself. So how do you know if it's right? How do you know if your accountant is doing the right thing? Because, to try and explain it to somebody that doesn't have that accounting knowledge, it's really difficult. So that's why Mena and I wanted to talk about what are some of the red flags, just to try and help people, because often we come across, obviously new prospective clients, and they wouldn't be approaching us if they were really happy with their existing accounting relationship. And we see a lot of these issues and problems. And we find it kind of interesting that people tend to be kind of reluctant to move accountants. I don't know really what it is. Maybe it's just the safety of the person that they're dealing with knows all the history, or they've been with them for a long time. But actually, switching accountants isn't that big a deal. It's a pretty easy and smooth process. It happens a lot in the industry. So, accountants are used to it as well. The clients will come and go for different reasons other than, whether they're happy or satisfied with the service. So it's not that big a deal. And I think the accountant occupies such a really important role in someone's business. You must ensure that they know what they're doing and that they're treating those matters appropriately. And of course, accountants should be more than just the numbers. Hopefully that you can have discussions with your accountant about more value adding matters, like how can you grow profitability? Is there anything particular in your situation that you should be focusing on? They're really there to interpret the numbers for you and make sure you're doing a great job. So anyway, let's talk about some of the red flags, Mena. And what we wanted to talk about initially is bank reconciliations. And again, I know it sounds like a really boring subject, but they are critical in the whole accounting process and system.
That's right. And look, I'm not going to make this as riveting as it sounds, but I'll try my best to keep you guys engaged. But so the first thing that bank reconciliation does, it compares the company's accounting records, obviously, with their bank statement. So what this process allows you to identify, or allows the accountant to identify, is missing entries, unrecorded deposits or payments, errors in recording transactions. So, whether there's been wrong amounts, or there's been amounts that have been allocated incorrectly, or if there's been duplicated entries. It can also sort of flag fraudulent or unauthorized transactions. So, and what I've found is whenever that has occurred, it's because a bank reconciliation has been overlooked. So if your bank doesn't balance to your accounting system, that's immediately a huge red flag, because now with obviously live bank feeds, there shouldn't be an instance where it shouldn't not reconcile. So it's really important to stay on top of it and make sure that the income and expenses have been captured correctly. And obviously it has major downstream issues too. It could under or over report profits where you're sort of under or overpaying tax, similarly with GST. And then there could be cash flow surprises as a result, where you think that you've paid all your suppliers, but something's been misallocated and you've actually still got that supplier to pay. So bank reconciliations help us to identify fraud, missed deposits, or duplicated payments. So just a sort of a tip here for business owners: ask your accountant how often they reconcile your accounts and whether you can see a report showing reconciled items. So I always encourage business owners to hold their accountants accountable, in the sense that you should know how to go into your accounting system and run a bank reconciliation report. I'm not saying that you should do the bank reconciliation, but just run a report to make sure that things are being allocated correctly, and do a bit of a sample check yourself.
It really is a number one thing. I think before anyone starts a business, I reckon that's the thing that they should learn right from the outset, how important it is. Because, I mean, that's one of the things, right? You just want to make sure that, nothing's going awry and everything's moving in the right direction. I've got massive OCD, so I reconcile our bank accounts on a daily basis. I wouldn't recommend it. It's a problem that I need to seek a solution to. But look, I think at least every week, and appreciate you might not have the time nor the inclination to do that. But if that's the case, just get a bookkeeper. They're pretty cost effective these days. But I think that's the number one thing. Make sure your system is up to date and reconciled. You'll identify errors or issues on a timely basis, and also things like fraud, very difficult for that to occur without you finding out about it very quickly if you're on top of your bank reconciliation. Okay, so now Mena and I will just take it in turns and talk about some of the things that we see, some of the things that we see in accounts that are a bit of a red flag to us. And the first one is intercompany loans or loans to directors. Typically, that just creates a messy balance sheet and sometimes a messy group structure as well. Now, sometimes they're necessary on a temporary basis. So we might have them in 1 year with the view to get rid of them next year, and might be part of a tax planning process. But if they're compounding regular issues, that can be a red flag that things aren't structured correctly. So if there's intercompany loans going on, maybe there should be management fees being charged so that we've got the underlying profitability of each business, and then we can distribute the profit out of that business in a tax effective way. Similarly, if they're loans to directors, again, maybe the structure's not correct and we need to fix the business structure. Maybe it's a case of not having enough foresight to working out what a good distribution strategy looks like. But the problem with these things, if left unchecked and they continue for many years, you'll have a really large compounding problem. And when it comes to time to sell the business or, introduce a new business partner or something like that, it's going to cause you hassle down the track. So we like things to be nice and neat and clean as possible. And so that can be a red flag if it's not looking like that.
So another frequent mistake we find is GST not reconciling. And like I sort of mentioned before, this has sort of flow-through effects in terms of whether the GST collected is under or over-reported, meaning your sales have been either under or over-reported, and the GST paid doesn't match your returns or ledger. So we always encourage clients to ask their accountant, at least, to run a comparison between the ATO reports, so what's being reported in your BASs, to what's actually in your ledgers, because it will really give you an indication of how things are being reconciled and whether you're being overpaying or underpaying GST to the ATO.
The next thing is to run your eye down your balance sheet items and just make sure you think they are correct. So things like closing stock, debtors and creditors, these sorts of things. The big red flag for us, sometimes we get a set of accounts and closing stock on the balance sheet is exactly the same it was prior year. I mean, that's definitely a red flag. I mean, it's almost certainly not going to be exactly the same to the dollar. And it just shows that we haven't thought about, whether there's any stock that needs to be written off, whether we have overstated our cost of goods sold if we've got more stock than what we think. Just these sorts of issues. Same with debtors and creditors. Are there any bad debts we can write off, get a tax deduction this year? Similarly, are we capturing all the creditors to make sure that things are being paid on time? Again, that can be a bit of a red flag for fraudulent activities as well. If you think your creditors are being paid but they aren't, you should be able to see that or pick that up on your balance sheet. But every year you want to look down the balance sheet and go, yeah, that number is correct. You can substantiate that number and you know it's up to date.
Another frequent mistake we find is around misclassified expenses. So, for example, classifying expenses as capital versus revenue, whether they get picked up correctly in the fixed asset register and you're able to depreciate them. Or another example is we find is around personal versus business expenses. So, for example, we have a lot of clients that link their credit cards to their accounting system and they have both business and personal expenses on there. So, and I understand, want to accumulate points and so forth, but this can, if not managed correctly, it can really affect your tax deductions and depreciation as a result.
Another thing that would drive us to the asylum is clients implementing their own journal entries into Xero or whatever bookkeeping system they use. Sometimes a little bit of knowledge is dangerous. So sometimes we have clients go, oh, I studied accounting at university, which might have been 20 years earlier. It's okay, I can do these journal entries. Look, of course, there's going to be some people that do have the knowledge and experience to do that aren't necessarily accountants per se, but really fiddling with these things or making manual adjustments in your bookkeeping system, your accounting system, I should say, is not ideal and then can lead to mistakes where things aren't balancing or the numbers don't make a lot of sense.
So just coming back to the bookkeeping issue, I think that's probably one of the most things that we see done incorrectly, because if inconsistent bookkeeping practices, even if it's for just a few months, can create a whole lot of chaos down the track and for when your accountant actually comes to prepare the accounts. So, whether it's been allocated into a different category or a different date or a missing invoice or the GST hasn't been applied correctly, for that to all be unraveled, it's a lot. It's like finding a needle in a haystack. You start questioning every single transaction in that period, and it's a whole lot of chaos and a whole lot of work, and unfortunately can be quite costly. So I want to take this opportunity to sort of talk about what to do if you're unsure, because we have a lot of prospects and a lot of clients that have sort of reached out to us and said, we're not really confident, that everything's being allocated correctly. Our accounts are up to scratch. We feel that our business is doing better than what's actually in the financial reports, or vice versa. So I think the first step is to ask the question. Ask your accountant. So it's all well and good. I welcome our clients to ask me if they feel that something's off, and scrutinize and get them to provide explanations. Now, if they're not willing to provide explanations or get defensive in their approach, then that's a big red flag there. Because if there's nothing to cover up, then they should be more than willing to provide you that information. So if you're genuinely concerned and it's demonstrated your accountant isn't up to scratch, consider switching. Most reputable accountants will review your financials first, highlighting any errors. I know we do it firsthand here when a client approaches us. We ask, obviously, in confidence for the financials first before any engagement, so that we can basically have a high-level review and to basically demonstrate value. Because if everything's good, we want to be upfront and honest and say, look, we have no immediate concerns. We think everything's done correctly here. Whereas in more often cases, more often than not, we've actually highlighted errors and explained certain improvements to that client. If you don't want to move, you can always pay for a second opinion, because understandably, sometimes there's, like Stuart said, a lot of people are a bit hesitant about moving accountants. There's a bit of a relationship there, or your finances are somewhat in their hands. But a short review can quickly identify mistakes and reassure you that your accounts are accurate. I call it an insurance policy. It really sort of makes you feel that your accounts are in order, so that if there was ever an ATO review or audit, that you're in safe hands. So just remember, a small investment in a review can save you tens of thousands in taxes, penalties, or interest charges, or just missed opportunities. And we've seen it day in, day out.
So there you go. There's some of the common tips or red flags that we can see when a client doesn't have an accountant that is doing their job well or should be doing their job well. And, I just think that the nirvana, if you like, is having a perfectly clean set of books that are up to date and regularly updated, throughout the year via a bookkeeper yourself or your accountant. That just makes the whole end of year process, tax planning process, advisory process a lot simpler, and make sure that you uncover as much value from your holistic accountant as possible. And I think that's where, everyone that's in business, that's where they should be aiming to get to, as opposed to a really messy set of accounts that you're, crawling over each year just to minimize tax, and you end up lodging your tax return, a few weeks after the deadline each year just because you're scrambling at the end of each year. To us, that's not an enjoyable process. It's not a process that's going to maximize value. And we think a more proactive approach that results in much better outcomes is far more productive. Okay, that's it from us for this week. Until next week, bye for now.